Hey, welcome back to Lunch at the Market. Today has been fantastic for our portfolio, and if you've stuck with many of the trades that we have, then you as well are finally getting rewarded today. Being a successful investor is about managing your positions day to day, taking profits when you have big ones, and adding to positions when you're right. The trick there is to actually be right when you add to positions and not chase good money after bad. Part of why we like shorting put spreads is that we already know the time frame that we're going to be in the trade. Well, at least until it goes against us, right? And defending our positions by rolling those out or rolling those down and out, a la pretty much every video we've ever done in the last 3 months, means that we're often, you add to the trade. So for instance, take F5. That was a terrible trade. Short at 105, 100. Stock goes to like 91. We have to roll those down and out to a month somewhere out on the calendar. If you're short 10 spreads, to get out of it and still be profitable and get down further out on the calendar, you probably have to double the size of the position, so you'll be short 20 spreads. Okay? That means that you've added to that position. So the moral of that story is that's why you have to be right. Otherwise, you're chasing good money after bad, and all you've done is just increase your risk. Because for every $5 wide spread that you're short, that's $500 that you could lose. So 20 spreads times 500, was that 10 grand? I'd have to do the math real quick. 500 times 20. Yeah, so that's 10 grand. So if you don't have 10 grand to risk, don't make the trade for that kind of size, okay? So your starting position size should be like 2 spreads in F5, which doubles to 4, and so your max loss is 2,000 instead of 10,000. All right, so that's how that works. So we like that options defines how long we're going to be in the trade. We also like that we already know what our risk of loss is before we even put the trade on, right? It's $500 per $5 wide spread. Okay, so put on trades that are appropriate to your size, your portfolio size, your risk tolerance, all that stuff, and be committed to staying in the trade. One of our YouTube videos, sometime this week, somebody had pulled up a video from back in February and said, hey, I lost my butt on this trade, and my comment to them was, A, just so you know, we're not right all the time, and then B, we'll actually end up being right because we roll those down and out. I think it was Motricity. We were short the 17, 15, 17 and a half, 15 put spreads. We had to roll those suckers out, I think to April, so they should be coming up this month, but now we're short the 15, 12 and a halves. And it looks like Motricity, as of right now, fingers crossed, is already above that $15 water line. And so as long as it stays there by April 15th, then we'll actually be profitable on our Motricity trade, even though it went against us terribly. It sure didn't hurt to have the CEO come out. He went to the wireless conference recently, and things are looking good for Motricity. He also, it was really nice to explain, right, the business model as in terms of when you go on the internet, where are you seeing Motricity? So check out Jim Cramer's interview from yesterday with the Motricity, M-O-T-R, CEO, if you want to learn more about what Motricity does. And we encourage you to do so because you need to do 1 hour of homework per week per position that you own in order to be good at what you do. Okay, so today's trade was on silver, the SLV. The iShares Silver ETF, right, SLV. We asked Brian Kelly Canun, which is, of course, Brian Kelly from Fast Money, about a week ago, where did he sit in his silver trade? He said, I'm sitting pretty. I'm going to hold on to my position. He may have even added when it was down last week. Thank you very much, Brian Kelly. Terrific job, well done. We're up 45% in our 2012 25 strike SLV calls. Notice that we're in the money. We're in the money because we don't like to lose money. So those things are up 45%. Boom, we hit the sell button today. It looks like we top ticked it, at least for now. We sold them for about $12.90. We did Twitter that out, so you didn't miss it real time. And then now you can only get about $12.25 for them. We sold them for $12.90. So that worked out pretty well. Hopefully you're following us on Twitter. If you are, you get the most up-to-date real-time advice, information. It's not really advice because I have no idea what you guys are trading out there. But we are at least letting you know what we're doing on a portion of our personal portfolio, well, our company's portfolio. So that's probably a good place to say that this isn't advice. This is just a free educational service that we're doing so that you guys aren't there shooting against the professionals all by yourselves alone. Okay, so speaking of being out there all by yourself alone, the profit gap, right? The profit gap is the difference between what your strategy should make and what your strategy made with you executing it. For more on the profit gap, tune into the Jared Levy episode of America's Favorite Traders, or AFT, and you can find out how to minimize the profit gap and exactly what it is. To find that, you just go to magnumopusfinancial.com, click on the button for America's Favorite Traders. All right, we did also wave the white flag on ITRON 50-55 put spreads that we were short, F5 105-100 put spreads that we were short, NTAP 50-45 put spreads that we were short. We had those all on for April OPEX, and to be honest, we want the bar set really, really low for April OPEX. See, the strength of being short put spreads is you only need the stock to just not go below where you're short. You don't need the stock to go up. You don't care if it goes sideways. You don't even care if it goes down a little bit. You only care if it breaks your short strike. And so with all of those trades that we just said, we actually needed the stock to rally into April OPEX in order for us to be profitable. So we like to set the bar lower. Low expectations are good expectations. It makes it easier to be profitable if you have low expectations. If you sell an in-the-money put spread, then you need the stock to get off its lazy butt and do some work. And we don't like stocks to have to do any work. So we like higher probability, lower risk, and more certain that we're going to walk away profitable. All right, on F5, just a little trick today. When you roll out something like it's completely in the money put spread, right? We like to spread that out on the calendar, meaning if you're short 10 spreads, you take 2 of them and you roll those down and out. Those become 4, say July. Then you take 2 more, throw those out to August, then September, then October, then maybe January 2012. Okay, you throw them out on the calendar. That way, instead of having to deal with a big, giant 20 lot, when you come up on your position, you only have to deal with 4 spreads at a time, which makes it easier to manage and more likely that you'll get out of the trade unscathed. Does that make sense? The only time when you'd really want to hammer it and go after the next options expiration or the next month out is if you're really concerned that the stock's going to roll over and that you might have been wrong. In that case, what you want to do is throw a little size at it and go after just the next month, okay? Because over the long term, the stock might continue to decline, but in the short term, what you want to do is just be there to catch that bounce, even if it's a dead cat bounce. Again, the beauty of being short spreads as opposed to being long the stock and needing the stock to actually go up for you to make some money. Hope that's a helpful tip as well. All right, don't forget the James Altucher's America's Favorite Traders episode. Love him or hate him, but at least listen to him, right? So then you can disagree with him and say mean things to him on Twitter, which we'd rather that you not actually. But if you need to, you should have some cannon fodder for that. And you can get that by tuning into America's Favorite Traders and checking out James Altucher's episode. We just had him on the show. It's great stuff. It's about an hour behind the scenes, totally in depth. Can't get it anywhere else. Info between me, yours truly, Brad, and James Altucher, who's about 10 times more famous than I am. We're working on that. All right, so check out America's Favorite Traders. You can check out all 10 episodes. They're all good. Of course, we're going to have new guests upcoming. We've already got some new faces, fresh faces that weren't on the show last season coming up for you. Stay tuned for those. You got to check the website, or you can subscribe to our podcast on iTunes. Then you get automatic updates. Remember, lazy means low expectations. Low expectations means it's easier. So have low expectations for yourself. Subscribe to the podcast on iTunes. You're looking for America's Favorite Traders. Type that in. You'll get it pulled up. Thanks for tuning in again today. Don't forget, if this went really fast, then check out stockpicker.com. Look at the articles section, and then you'll find, just look for the Lunch at the Market. When you get there, a lot of times there's a link to our whole Lunch at the Market page. And then we're working on putting that on our website, which means that eventually you'll be able to just go to our website's Lunch at the Market page. You get the video, you get the text, you get the video, you get the text. No, the live show. You'll be able to watch the live show right there from the Lunch at the Market page. Thanks for tuning in again today. Have a great day, and we'll see you tomorrow.